Hello and welcome to another quick Smaulgld live stream. Today is Tuesday, the 8th of October, 2019. And this video is an update to yesterday's Fed repo collateral equals agency mortgage-backed securities, agency debt, and U.S. Treasuries. And in that video, we discussed and tried to clear up some of the confusion around who is getting access to the Fed's repo facility, and we went through the Fed's primary dealers. There's about 29 of them. I'm going to show them on the screen for you right now so you can see who they are. And then we also discussed what type of collateral they have to put up in order to receive access to the facility. Now, we did mention that the primary dealers, this is somewhat of an incestuous relationship between the Fed and its primary dealers. As the Federal Reserve Bank of New York points out, primary dealers are trading counterparties of the New York Fed in its implementation of monetary policy. Stop. They are not just primary dealers, they're actually partners with the Fed in conducting monetary policy, and part of the repo operation is to keep short-term interest rates low. And it says they're expected to make markets for the Fed on behalf of its official account holders as needed. In other words, they're called upon to do a service, just like to the Godfather, and to bid on a pro rata basis on all Treasury auctions at reasonably competitive prices. So they're expected to play along to get along. Who are these primary dealers? We went through this a couple of nights ago. There's the list. It'll be on the Smaulgld website. Interesting to note, half of them are foreign banks. Let's move on quickly to the purpose of today's video, which is to show the difference between mortgage-backed securities and agency mortgage-backed securities and how they appear on the Fed's balance sheet. Now, when the Fed explains, the New York Fed explains what are mortgage repo operations, they explicitly state that they use these primary dealers. The primary dealers can access the repo facility. And they explicitly state in a repo transaction, they buy treasuries, agency debt, or agency mortgage-backed securities. When I say they buy, they take temporarily as collateral in exchange for the cash. And it says it's economically similar to a loan collateralized by securities having a value higher than the loan to protect the desk against market and credit risk. Repeat that. These are securities that have a value higher than the loan. The reason for that is these are deemed to be good collateral. Now, there's been some confusion. How can these mortgage-backed securities be good collateral? Because they're not mortgage-backed securities in the sense that they're the private ones that we heard about during the 2008 financial crisis, which were mortgages that were bundled up by banks and other entities. They were rated by the rating agencies, and they shouldn't have been rated so high, and they went bust. This is not what the Fed says they are adding as collateral or accepting as collateral. These are agency mortgage-backed securities. These are the ones from Ginnie Mae, and these are the ones that are deemed to have no credit default risk other than the default of the United States itself. So when they take this collateral, treasuries are also deemed to be the least risky asset on the planet. Anything backed by the United States, they say, is backed by the full faith and credit of the United States. And in the world today, that is deemed to be the safest. Now, we can argue whether that should be gold, obviously, but the point being is that there's a vast difference in the credit markets between agency mortgage-backed securities and any other paper, U.S. Treasuries and any other paper, and agency debt. Those are the three types of assets that the Fed will take as security for this repo facility. This is nothing new. This is what they stated they would do. In fact, every night they show, and have been showing for about 25 days, what they have been accepting. It's no big shock and surprise that they're accepting mortgage-backed securities. Here you can see on the chart, in the most recent repo operation, 11 billion of mortgage-backed securities were put up for collateral and accepted by the Fed. Now, some of the confusion is indeed part due to the Fed naming them on this little chart here mortgage-backed securities instead of their proper name, agency mortgage-backed securities. However, let's take a look at the balance sheet, and this is the important point. A lot of people are misunderstanding. They're saying, well, wait a minute. The Fed is adding mortgage-backed securities, but they're supposed to be rolling these mortgage-backed securities off their balance sheet. And indeed, that is what they're doing. They are rolling off the mortgage-backed securities that they purchased as part of the bailout during the financial crisis. And that, you can see, is the line item that has 1.467 trillion that says mortgage-backed securities. There's a footnote there. I don't have it showing, but what that footnote essentially says is it includes the premium that they paid because they paid full price for many of the mortgage-backed securities when they really were only worth maybe 10 cents on the dollar. So they have that 1.46 trillion on the balance sheet. Now, if the Fed is buying mortgage-backed securities, the line of questioning goes, as part of the repo operation, how come the numbers are not the same? They don't reflect the addition of the mortgage-backed securities in that line item. Well, the answer is because they have a separate line item for repurchase agreements. And the repurchase agreements include the net amount of collateral that they have pursuant to the repurchase agreements, which includes the agency mortgage-backed securities, the U.S. Treasuries, and a certain amount of, small amount of agency debt. I hope that clears it up. There's a lot of this, I would say, nonsense out there, people mischaracterizing and speculating on what the Fed is doing, who they're doing it with, whether they don't know which banks, they don't know whether they're doing CLOs, toxic junk, and now they're saying mortgage-backed securities. If you can go by what the Fed says, they have been transparent what the repo is, what the repo operation, what the purpose of it is, who's involved, and which securities are taken as good collateral. I do fault the Fed for using the term mortgage-backed security. They should be more explicit in their terminology. They're talking about agency mortgage-backed securities as part of the collateral, but they do indeed on their balance sheet make the distinction between the mortgage-backed securities that are on their balance sheet and have been on their balance sheet, that massive $1.46 trillion number, and the more modest repurchase agreement, which includes some agency mortgage-backed securities of $171 billion. I hope that helps. Thank you very much.